Imagine a company reporting what look like, blockbuster earnings, a massive swing into profit, just crushing Wall Street expectations. Your first thought might be, wow, what a quarter. But here's the paradox we often see. Is that headline profit really what it seems? Is it genuinely reflecting a thriving core business, or is there maybe something else driving those impressive numbers? Today, we're doing a deep dive into KULR Technology Group's Q2 2025 earnings report. As always, our mission is to take your source material, this stack of earnings analysis, and pull out the most important nuggets of knowledge, the key insights. We'll use our structured five-part framework to cut through those headlines and really help you understand the full story, blending the official company data with, market expectations. And what we're going to find here is, well, a fascinating contrast, a really stark difference between KULR's actual operations and some non-operational crypto-driven gains.
Exactly. And that contrast, that dichotomy you mentioned, that's precisely why this specific earnings report from KOR is so, well, captivating. It's not just about the raw numbers on the page. It's about the intricate story they tell, and maybe more importantly, the implications of that story for you. Whether you're just curious, a potential investor, or someone trying to figure out what really drives a company's financials in today's pretty complex market, we're going to try and unmask the real drivers here.
Okay, let's unpack this then. Now for slide one, the at-a-glance scorecard. Let's start by looking at those initial headline-grabbing numbers. So on the surface, KULR's second quarter of 2025 looked, well, absolutely spectacular. They reported total revenue of $3.97 million. That's a huge 63.4% increase from the $2.43 million they had in Q2 2024. And it comfortably beat Wall Street's estimate of $3.45 million, so a clear beat on revenue. But the real stunner was the bottom line, net income. $8.14 million. I mean, think about that. It's a massive reversal from a net loss of nearly $6 million just last year. And this translated into a diluted earnings per share, EPS, of $0.22. That figure just blew past the analyst consensus estimate, which was actually for a loss of $0.12 per share. You could really call this one of the most significant beats of the whole quarter.
For me, that huge outperformance on the diluted EPS compared to the revenue growth, that's the real headline. It just screams, wait, how did they do that? Especially when, the core business operations were, well, still burning through cash. And remember, that $1.22 is diluted EPS, so it already accounts for potential future shares, things like convertible securities. It's supposed to be the more conservative number. So even using that measure, the number looks amazing on the surface, which frankly makes the story underneath even more interesting.
That immense EPS beat, despite the core business still losing money, that immediately makes you ask, okay, what exactly is driving such a huge swing? It seems almost too good to be true, doesn't it?
It really does. And the answer isn't in selling more widgets or becoming super efficient overnight. It's actually in two major financial events that happened. First, the company's own press release says pretty clearly that the net income was primarily driven by a mark-to-market of the company's Bitcoin holdings. Now, this is absolutely crucial. It's a non-cash accounting gain. It's not profit from their actual tech business. Think of it like if you own a house and its value goes up on Zillow. On paper, great, you're richer, right? But you haven't sold it, so there's no actual cash in your pocket. Same idea here with their Bitcoin. Second, KULR did a 1-for-8 reverse stock split back in June. This massively cut down the number of shares outstanding from around 300 million to only about 40 million. So that spectacular 0.22 EPS number is basically just a formula. A large unrealized gain from Bitcoin divided by a much, much smaller number of shares. It mechanically creates this high positive EPS number, but it's totally disconnected from the actual health, the underlying health of the company's core technology business.
Right. Okay. That makes sense. It's financial engineering, not operational success, driving that specific number. Moving to slide 2. The engine of profitability, which you said really tells a tale of two ledgers.
Exactly. To really get a handle on KULR's financial health this quarter, you almost have to look at it like two separate sets of books, one for their core tech operations and a completely different one for this new Bitcoin treasury strategy they've adopted. In doing that, it reviews this crucial split. Yes, they're hitting record revenue, which is good, but the core business itself, it's actually getting less profitable operationally. That impressive headline net income number we just talked about, it came entirely from the crypto side. So let's start with the core operations ledger. This is really a story of, well, unprofitable growth right now. Despite that big 63.4% jump in revenue, KULR's actual ability to turn that revenue into profit from its main business, it got worse. Their gross margin, which is, fundamental profitability after direct costs, it fell pretty significantly, down from 24% last year to just 18% this quarter. And the company itself said this was because of unanticipated labor hours needed to complete technical projects. That suggests some real challenges, maybe cost control, maybe execution, particularly on the services side.
And then, On top of that weaker margin, their operating expenses shot up. Selling, general, and administrative costs, SG&A, rose over 51% to almost $7 million. Why? Well, more spending on advertising, marketing, even stock-based compensation. And at the same time, R&D spending, which is their investment in the future, that surged even more, up 86% to $2.44 million, mostly due to planned consulting services. So you put it together. Lower gross margins, much higher spending, and the result is their loss from operations actually widened by a huge 77.3%, from about negative $5.3 million last year to negative $9.45 million this quarter. This shows what we call significant negative operating leverage. Usually you want profits to grow faster than revenue as you scale up. But here, the operating loss grew even faster than that impressive revenue growth. It basically means for every new dollar of revenue they brought in this quarter, their total cost went up by more than $1. Not sustainable.
Wow, okay. That paints a very, very different picture of the core business, doesn't it? A significant operational cash burn hiding behind that strong revenue growth. But like you said, that massive net income figure didn't come from those operations. So let's shift gears, talk about the other side of the story, the real source of that reported profit.
Right. This brings us straight to the Bitcoin Treasury Ledger. This is, without a doubt, where their reported profit came from this quarter, that $8.14 million net income, generated entirely by the company's Bitcoin holdings, not by selling tech. And like we said, it's a mark-to-market accounting thing. It's unrealized. It's a non-cash paper gain, just reflecting that the price of Bitcoin went up during the quarter, not from actually selling anything. And here's a really crucial point. Lots of companies, when they have these kinds of volatile, non-operational items, they'll report a non-GAAP or adjusted earnings figure to show you the core business performance. KULR didn't do that. If they had shown an adjusted number excluding the Bitcoin gain, it definitely would have shown its significant loss. And honestly, that would have been much more representative of how the core business actually performed, its cash burning reality.
Okay, that's a critical distinction. So the headline number looks great, but the underlying business reality is quite different. Now for slide 3. The engine room business segment performance. So let's dig a bit deeper. Where exactly is this growing revenue coming from? Which parts of the business are driving it? And, maybe more importantly, is that growth healthy growth?
Yeah, excellent question. If we break down KULR's revenue, we see growth in both products and services. Revenue from product sales, that grew really strongly, up 75% year over year, went from about $1.1 million to nearly $2 million in Q2. So that segment is now almost exactly half. 49.9% of their total revenue shows how important their actual physical tech is. The other half, $1.99 million or 50.1%, came from services, consulting, technical projects, that sort of thing. Now, this segment, while it's bringing in half the revenue, it seems to be the main reason profitability went down, like we just discussed. Remember the company's explanation for the lower gross margin, those unanticipated labor hours needed to complete technical projects. That points right at the services side. It makes sense, right? Selling a standard product is usually more predictable. Service projects, custom work, they inherently carry a much higher risk of cost overruns, and it looks like that risk showed up this quarter, hitting their bottom line.
That's fascinating. So the very engine driving half their growth, the services side, is also kind of dragging down the operational profitability. Bit of the double-edged sword there. Still, despite those cost challenges, they must be doing something right on the innovation front to get that kind of top-line growth overall. What are some of the actual things they highlighted? New products, projects?
Oh, absolutely. You don't get that kind of revenue growth without real progress. And KULR did highlight several tangible achievements in their press release. These show they are bringing innovative stuff to market across different sectors. For instance, in commercial space, they shipped their K1S 500 XLT battery platform. That's a lightweight battery system designed for the private space industry. In robotics, they released the 7th generation XLA exoskeleton that's developed with German Bionic, and they're introducing it now in North America. For defense, they successfully demonstrated a ballistic-proof battery for the DoD, which is obviously a big deal for safety. And in the maritime sector, they finished delivering a specialized battery that can handle extreme pressure underwater to a key strategic partner. So yeah, the innovation engine is definitely humming along. These are real products reaching customers.
Okay, good to see that innovation is still happening alongside the financial shifts. Let's move to slide 4. Financial strength and shareholder rewards. Now, this is where, as you mentioned, KULR made some really distinct, maybe even audacious moves. What stands out here?
Audacious isn't a bad word for it. KULR definitely undertook some major actions to completely reshape its financial structure and how its stock is perceived. They're clearly going all in on this Bitcoin first strategy. So as of June 30th, they had about $24.7 million in combined cash and current accounts receivable. That's their short-term liquid stuff. But the really strategic piece, the game changer, is their new capital structure. They got a $20 million credit facility with Coinbase. Now listen closely. This is not your typical corporate loan based on business cash flow. No, it's a credit line secured, collateralized by the company's Bitcoin holdings. This gives KULR a big chunk of capital they can use to fund those cash burning operations we talked about, or even buy more Bitcoin. But, and this is a huge but, it brings in this completely new and potentially very significant risk. What happens if Bitcoin's price tanks? Well, KULR could face a margin call. That means Coinbase could demand they pony up more Bitcoin as collateral, or, and this is the scary part, force them to sell Bitcoin to pay back the loan, possibly at a huge loss right when the market is crashing.
It's a really high-stakes gamble that ties their financial health directly to crypto volatility.
Wow, so they're essentially borrowing against a highly volatile asset to fund a business that's currently losing money operationally.
Yeah.
Well, it's definitely bold. And what about that 1-for-8 reverse stock split we heard about earlier? What was the thinking behind that?
Bold is one word for it. And yeah, the reverse split was another piece of this strategic repositioning puzzle. They did that 1-for-8 split back in June. Basically, they took every 8 existing shares and bundled them into one new share. This instantly multiplies the share price by 8, although it doesn't change the total value of your investment at that moment. The company said the goal was to optimize market dynamics and broaden investor appeal. But the practical reasons are pretty clear. It was almost certainly done to get the share price comfortably above the minimum listing requirements for their exchange, the NYSE American. Often that's like $5 a share. And maybe just as importantly, it makes the stock look more appealing to big institutional funds. Many of them have rules against buying stocks that trade below a certain price, sometimes called penny stocks, even if the company itself is interesting. So it's about perception and accessibility too.
Okay, so boosting the share price, looking more appealing to institutions. And speaking of attracting a wider net, what about getting into the Russell 3000 index? What does that actually mean for a company like KULR? Sounds like a positive step.
Oh, it absolutely is a positive step and definitely part of that same strategy. Getting included in a major broad market index like the Russell 3000, which happened effective June 30th, is a big deal. For one, it massively increases the company's visibility. Suddenly, KULR is on the radar of many more investors and analysts who follow that index. But maybe more importantly, it creates automatic buying demand. Think about all the index funds and ETFs out there whose whole job is just to track the Russell 3000. Well, now they have to buy KULR shares to match the index's holdings. This provides a sort of built-in floor of demand for the stock, helping their goal of attracting that wider, potentially more institutional investor base. It all fits together.
Right, it's all part of a package to change how the stock trades and who owns it. Makes sense. Finally, we arrive at slide 5, the road ahead management's outlook and key takeaways. So, after all this maneuvering, what is management actually saying about their position now and where they're headed?
Well, management's comments really double down on this strategic pivot. They frame the Bitcoin treasury not just as some side investment, but as like the central pillar of their whole financial strategy now. The CEO, Michael Moe, he said, and quoting here, KULR is in its strongest financial position to accelerate its growth and continue its innovations. Our Bitcoin holdings provide a solid financial balance sheet that enables us to invest confidently. I mean, listen to that. He's explicitly saying their confidence to invest comes from the crypto assets, not from cash generated by the core business. And the CFO, Sean Cantor, kind of echoed that, laying out the 2 tracks they're on. He said, "We are proud to deliver another revenue record quarter. We continue to invest for KULR's long-term growth and scalability. In parallel, we are executing on our Bitcoin treasury strategy." See, he clearly separates the 2 things, using the Bitcoin balance sheet strength to fund the investment and the cash burn needed to scale up the actual tech business. Very deliberate.
Okay, so management is fully embracing this dual strategy. After digging into all these numbers, the strategy, the risks, what does it all really boil down to for you, the listener, trying to understand KULR and its future? Let's try and synthesize the key takeaways.
Absolutely. Let's distill this down to what really matters from this quarter. First, strong revenue growth masks operational weakness. Yes, KULR hit record revenue, beat estimates, that's good, shows demand. But the underlying profitability of the core operations got worse. Falling margins, much wider operating loss. It clearly shows the main tech business isn't scaling efficiently yet, not close to profitability. Second, the headline profit is an accounting gain, not a business profit. That amazing EPS beat, almost entirely due to that non-cash mark-to-market gain on Bitcoin. It's what analysts call a low-quality beat. Why? Because it doesn't reflect actual cash coming in from the business, which is still burning cash. Third, KULR has transformed into a leveraged bet on Bitcoin.
this Bitcoin-first strategy. It fundamentally changes what investing in KULR means. Sure, it gives them a potent, though super volatile balance sheet and access to capital through that Coinbase loan. But it ties KULR's financial future and its stock price directly to the wild swings of crypto. Huge new risk profile. And fourth, strategic repositioning aims for a new class of investor.
That reverse stock split, getting into the Russell 3000 app, these weren't random. They are very deliberate moves to make the stock trade better and attract big institutional money. Its singles management is actively looking for investors who are okay with this high-risk dual strategy, part venture tech, part crypto speculation. So the final narrative from your source material really wraps it up nicely. KULR's Q2 2025 was a landmark, a strategic turning point. That strong revenue, it proves people want their cutting-edge tech. But the widening losses, they hammer home that this is still very much a high-investment, pre-profit company. And management's answer wasn't traditional funding. It was this audacious move to anchor the whole company treasury to volatile Bitcoin. The result is this quarter where the fantastic headline profit came straight from financial engineering, not operational success. So for anyone looking at KULR now, it's become this dual narrative. It's a venture stage bet on cool battery and thermal tech, yes, but it's funded and leveraged by a speculative bet on Bitcoin's future. Two very different bets rolled into one company.
That really crystallizes it. This analysis absolutely shows how vital it is to look beyond the headlines, dig into the financial engineering, and understand these potentially conflicting narratives within one company. So what stands out most to you about this unique, high-stakes, dual strategy KULR is pursuing?
You know, this whole deep dive just underscores the value of having a structured way to look at earnings. It really helps you, the listener, get past those flashy headlines. It lets you understand what's really driving performance, assess the actual financial health, and figure out what management is truly signaling with their actions and words.
And just a reminder for everyone listening, this deep dive is purely for informational purposes. It does not constitute financial, investment, legal, or tax advice. Please always do your own research before making any investment decisions. This report was generated by an artificial intelligence model integrating data directly from KULR's official earnings press release with publicly available market data. All the information, including the financial data and calculations, should be independently verified by you before making any decisions based on it. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.